Okay, so in this video, I'm going to be going over the Module 6 analysis of financial statements. So we'll start with what is the analysis of financial statements. So in the financial statements, there are basically four things that you can do. So you can calculate the profitability, you can also calculate the liquidity, you can calculate the solvency, and you can calculate investor ratios. So starting with profitability, what is that and what does it mean? So in your profitability, you have your gross margin, you've then got your net margin, you've got your return on investment, you've got your return on assets, and your return on equity. You've also got your asset turnover. In liquidity, you've got your current ratio, you've got your quick ratio, you've got your inventory days, your receivables days, and your payables days. In your solvency, you've got your gearing, your interest cover, and in your investor ratios, you've got your earnings per share, your dividend cover, your dividend yield, and your price to earnings ratio. Now we'll go into some before you begin questions. So, what is comparable company analysis of financial statements? So, comparable company analysis involves comparing one company's financial statements directly with those of another similar company and considering why differences may be evident. What is trend analysis? So a trend analysis involves comparing the results of one company over time. What are the broad groups of ratios that are relevant in any financial analysis? Like we've mentioned before, so we've got profitability, liquidity/efficiency, solvency, and investor ratios. How is your return on investment calculated? So that would be your earnings before interest and tax divided by your total assets minus your current liabilities times 100%. And what does this indicate? So this indicates how well management are utilising the resources available to them to make profits. So if this is you, it's how well you are utilising the resources available to you to make profits. How is your asset turnover calculated? So your asset turnover is calculated by your sales divided by your total assets minus your current liabilities. What does your asset turnover indicate? So your asset turnover is a measure of how well the assets of your business are being used to generate sales. What ratios indicate your solvency? So that would be your gearing and interest cover, which provide an indication of your solvency. Now, what risks are associated if you have a high level of gearing or leverage? So a high level of gearing is risky to you because as the high level of fixed interest makes your shareholders' dividends return more susceptible to profits. So in turn, this makes both equity and loan finance investors less willing to invest in your company. How is your current ratio calculated? So your current ratio is calculated by your current assets divided by your current liabilities. And what is the difference between your current and quick ratio? So your quick ratio excludes inventory from current assets in the calculation above. And how is your receivables days calculated? So your receivables divided by your credit sales times 365 is your receivables days. What does your inventory turnover period days indicate? So the inventory days indicates the time for which an entity holds goods before they are sold. So how long you're holding your goods for.